Welcome back to the special report, the Reddit Rebellion. Stocks soaring on Wall Street today with the Dow gaining 300 points. The rally coming as high-flying names like GameStop, AMC, Koss, and Express tanked. Tom Lee is a head of research at Fundstrat and a CNBC contributor. Tom, good to see you again.
Yeah, great to see you.
We chatted about the impact of this movement earlier this week, and then we saw a sell-off, Tom. And so I'm wondering how you think about whether or not this movement, this dynamic in Wall Street is causing any sort of ripple effects in the markets.
One thing to keep in mind for the viewers is this total U.S. stock market is about $33 trillion in market cap. And the sum of the market cap of, if you took even the 10 names that have gone parabolic and that were named in those threads, it's about 50 billion, which means it's like 0.00001% of the total stock market. I guess what I'm saying is there's a lot of activity and it's actually had a lot of impacts across Wall Street. But in terms of aggregate effect on the market's valuation, it's tiny.
Yeah, no, I get that. Isn't there, though, I mean, do you eliminate a few zeros, though, because of the power of options? And if you have an options position, that value is not 50 billion, it's a multiple of that. And it's not just, that particular stock, it is also the other stocks in combination.
Sure. Yes, that's right. I'm oversimplifying because there were a lot of corollary effects. People had correlations in their books go kind of wonky, and when some of these hedge funds had to shrink their long books, it was affecting a lot of traditional managers. So there were clearly a lot of effects. But to me, I think that the bigger story to me is still that this is a regime change. I think that there is, over the next 10 years, going to be a tremendous amount of new money coming into the stock market. And that's, let's say, we think it's almost $6 trillion. It's not going to be handed to an institutional investor or to a hedge fund or to a mutual fund manager. I think a lot of it will be self-directed and self-managed money. And so I think that what we're witnessing now is not going to go away, but I think it overall will contribute to a higher PE for the market because equity risk premium will fall.
So more and more individuals will be in the market. So they are going to be, even if you discount the impact they're having now, if you calculate the market caps and factor in the power of options, et cetera, in the longer term, they're going to be a much bigger impact on the markets. Do you think that changes the way, institutions invest their money?
Yes, absolutely. I think it's going to be a bitter pill to swallow. But for the last 10 years, the average tenure of a fund manager is 8.7 years. So the average person managing a professional portfolio started after 2009. They've operated in a world of declining rates, zero net capital inflows into the stock market, essentially zero presence of the individual investor, and the growing presence of algorithmic and systematic trading. So I think that the rules are now changing for those same people because the next 10 years, machines are much bigger now, but if there's retail inflows, they might be counter-cyclical to what an institution does. I mean, I think overall it's actually quite healthy. That's why large investment banks that have both retail and institutional tend to have a lot of ballast because they can actually help with order flow. So I think it's a pretty healthy dynamic, but it's really a brand new environment.
Yeah. Tom, it's so great to get your thoughts. Thank you. Tom Lee
Thanks.
of Fundstrat. Courtney, what do you make of that? It's a bitter pill. I mean, Wall Street has operated in a certain way for, I don't know, forever. And here we are. If Tom is right and this heralds some sort of a change where retail or individual investors have more power in the market, that could change things.
Look, Melissa, it's time for change, right? Like, let's be honest here. There's some good change and some bad change, but I think Tom is 1,000% right with his assessment. And honestly, it might make it fun again, right? I mean, let's think about this. If you now have to readjust your risk models, you have to think about additional inflows. I mean, look, institutions aren't struggling. Close to $40 billion over the last 7 days went into institutional funds. They're not going to struggle. But ultimately now you have people that are going to be participating in this marketplace. Let's look at the positive side of that. You have additional liquidity. You have additional ways to uncover potential gains on names. You have people that might take the other side of your trades, right? Whether you like Tesla or don't like Tesla, there's got to be somebody to buy it if you want to sell it and vice versa. And so I think this is healthy, and it is going to be a reset, and it's time for that reset.
Dan?
Well, maybe it's time for that. Courtney just mentioned that it may get fun again. Well, I remember the last couple times the stock market was really fun in the late 90s, and it crashed 50%. And many of the names that were having the most fun, Courtney, it's really hard to do this like this, okay? So the stocks that had the most fun lost maybe 70, 80, 90% of their value. There was nothing really fundamental to those stories at the time, and the market participants were really excited about it, okay? The next time investors had a lot of fun was flipping houses, and then the banks got involved in creating a lot of really interesting leveraged products. Well, that didn't go too well for the stock market either, and a lot of investors got taken to the cleaner, and their financial futures were ruined, okay? So here we are in the last year. We had a mini crash, let's call it 35% from the February 2020 highs. It lasted about a month and a half or so. The Fed started printing money. The Fed took interest rates to zero. They said they're never going to let them go higher. They moved the goalposts on inflation. They're going to let that run hot here. They put money in people's pockets who couldn't go to work, and then all of a sudden they started legal gambling on their iPhones, okay? And stocks only go up. This is the only thing that they know right now. So I have a feeling that the fun's about to end. You know, it is a fun game playing musical chairs when you're a few years old and you don't know what the heck's going on. But when the music stops and you lose your chair, it's really debilitating, and it can be debilitating for a while. So to me, I don't think there's anything really fun that's going on right now in the market. It's not us versus them. It's not the establishment versus the guys trying to stick it to the man. This is real stuff. It's people's money. And, we talk about these things. Pension funds are invested on. We have this massive unfunded pension problem here. And that's one of the reasons why so much money has moved out the curve, the risk curve and such. So
Dan?
I just don't think it's funny to play with financial futures like this.
I completely get what you're saying, and I understand it. But at the same time, do you believe that the market should just be open to all of these traders to allow them to make their own decisions?
Of course.
Okay.
100%. I do not disagree. Everybody, every citizen should be allowed to do what the heck they want with their money. They should download whatever app they want to do. But I just don't think it's particularly fair. I think that a lot of the behavior of late is just, it's not well intended. And it's really about sticking to the man. I've spent some time on these Reddit threads. They're like, we don't care if we lose all our money. We want to take them down. I mean, that is a sort of financial nihilism. It's not particularly good for a capitalistic system, in my opinion. And some people will come back and say, well, isn't that what hedge funds do? They do bear raids and they do all this sort of stuff. And maybe they do, okay? But again, when they act out of line, out of regulation, they get their hand slapped. So to me, I think that there's massive regulatory action. I don't think these people know what's coming for them in the next few months or next few quarters.
We are still in the early stages of this story, that's for sure. Still ahead here, a congressional crackdown, growing calls from lawmakers to level the playing field. Coming up, we'll hear from one congressman who says it's hedge funds, not individuals, that need to stop treating the market like their personal playground. And we're getting closer to the can't-miss interview with the CEO of Robinhood. That is coming up when this special report returns.
Next, the GameStop battle, the real-life